You want to get smart, fast, right to look at a complex report and instantly know what the key takeaways are.
Yeah, that's pretty much the goal here on the deep dive.
Exactly. So today we're doing a deep dive, really focusing on the financial heartbeat of, well, one of India's retail giants, Avenue Supermarts Ltd.
Right, the company that runs all those D-Mart stores you see everywhere.
That's the one.
And for this exploration, we've basically gathered a whole set of their official releases. Think of it like going straight to the source.
Okay, what have we got?
We've got their investor presentation, the official outcome from their board meeting, which includes the auditor's reports, that's important, their press release, and even a look at potential questions they were sort of prepped for.
Right, so a pretty comprehensive look.
We think so.
Okay. So our mission today, it's quite straightforward, really. We're going to dissect D-Mart's financial performance for the year that ended March 31st, 2025.
And importantly, we're not going to get bogged down in, endless accounting jargon.
No, definitely not. We're here to pull out the really vital insights, understand the story behind those numbers. Okay.
Sounds good. Let's jump in.
All right. Where should we start? Maybe the big picture first.
Yeah, let's start with the headline figures. For the whole fiscal year 2025. And, well, they paint a picture of pretty consistent growth, at least on the revenue side.
Okay.
Their standalone total revenue, it reached a pretty substantial Rs, 57,790 crore. That's up a healthy 16.7% compared to the year before.
16.7%. That's solid.
It is. And interestingly, their fourth quarter, so just the last 3 months of that year, it basically mirrored that same growth rate. Came in at Rs 14,462 crore, which is also a 16.7% jump year on year.
Okay, so that consistent revenue growth, it definitely grabs your attention, doesn't it? But here's where I think it gets, well, really interesting. When you look at the profit, the story has a bit more, let's say, complexity, especially in that final quarter.
Ah, right, the profit after tax, the PAT.
Exactly. So for the full year, their standalone PAT, it grew by 8.6%, hit Rs, 2,927 crore, which, is still solid performance.
8.6% growth, yeah, still good.
But in Q4 FY25 specifically, that PAT growth was way lower, just 2.6%. It reached Rs 620 crore.
Only 2.6% growth in profit versus 16.7% in revenue for that quarter.
Right. So while they're clearly selling more, are they actually making significantly more per sale? That big gap, nearly 14% between revenue and profit growth in Q4. That feels like the headline story here, doesn't it?
That's a very sharp way to put it. And you're right, this trend, revenue growth outpacing profit growth in Q4, it isn't just in their standalone figures.
It's in the consolidated ones, too.
Yeah, we see a similar pattern there.
Okay.
Consolidated total revenue for FY25 was Rs 59,358 crore, and for Q4 it was Rs 14,872 crore.
Okay.
And on the profit side, consolidated PT for the full year was Rs 2,707 crore, and for Q4 just Rs 551 crore. The absolute numbers are slightly different, obviously, but the underlying trend, it's the same. Profit growth lagging revenue growth in that last quarter.
And it's also important to mention, and this, I think, gives us confidence in these numbers we're talking about, SRB and CO LLP, the auditors, they issued an unmodified opinion.
Right, on both standalone and consolidated statements.
Yeah. And what that basically means for you, listening, is that the auditors have gone through the books thoroughly and found them to be presented fairly. No major issues or misstatements.
Which gives you a high degree of confidence in these figures, yeah. It's crucial context.
Absolutely.
Now, if we try and connect this back to, well, where all this revenue is actually coming from, D-Mart offers a really diverse range of stuff.
Right, they're not just groceries.
No, not at all. Their main buckets are non-foods. That includes your everyday fast-moving consumer goods, FMCG, toiletries, packaged snacks, that kind of thing.
Okay.
Then their core food products, obviously. And finally, general merchandise and apparel. So clothes, household items.
A bit of everything.
Pretty much. And this wide assortment, it likely plays a pretty key role in driving that consistent top-line growth we saw.
Makes sense. And they're reaching a huge number of customers across the country too, right? Where are their stores concentrated?
Yeah, they have a big footprint. As of the end of March 2025, they had 415 stores spread across quite a few states.
415, okay.
Maharashtra had the most, 116 stores. Then Gujarat with 66 and Telangana with 45. Those are the top three.
Interesting geographic concentration there. Mostly Western and Southern India, it seems.
It does lean that way, yeah.
Yeah.
And if we dig a bit deeper into what's actually driving that revenue surge in Q4, The CEO specifically mentioned it.
What did they say?
He highlighted that the Q4 revenue growth was primarily, his word, primarily driven by increased footfalls in their stores.
Ah, so just more people coming through the doors. Simple as that.
Basically, yeah. More shoppers physically visiting Dmart locations. It's a clear, tangible reason behind that 16.7% growth figure.
Okay, so more shoppers, strong sales. Got it. But let's circle back to that really crucial point we raised earlier, the profit growth lagging so much behind revenue growth in Q4.
Yeah, the profitability pressure.
Exactly. The CEO addressed this directly, didn't he? Mentioned a 3.4% decline in Pally before you even account for those prior period adjustments.
That's right. That's a key piece of the puzzle. Before adjustments, profit actually went down year on year in Q4, despite higher sales.
So what were the main reasons, the main headwinds hitting their profitability?
He pointed to three main factors really squeezing those profits. First, there's been heightened competitive activity, especially in that FMCG space, fast-moving consumer goods.
More competition.
Yeah. And this increased competition is putting downward pressure on their gross profit margins. Basically, they might need to offer sharper prices or more deals to stay competitive.
And that eats into their profits per sale. Makes perfect sense. The retail world is definitely a battleground.
It really is.
Okay, what else was hitting profits?
The second factor was a significant increase in wages, specifically for entry-level positions.
Ah, labor costs.
Exactly. Seems to be driven by a bit of a demand-supply mismatch for workers in those roles. So higher labor costs, naturally, that's going to impact overall profitability.
Okay. Competition, wages, and the third piece.
The third element is their ongoing sort of strategic investments, things aimed at improving service levels for customers.
Like what, specifically?
Well, ensuring better product availability on the shelves, trying to speed up the checkout experience, and importantly, continued investments related to actually opening new stores down the line.
Ah, so investing for the future.
Precisely. And while these investments are, crucial for their long-term growth and keeping customers happy, they do represent immediate costs right now.
Which affects current profitability, forward-looking spending hitting the present bottom line. Got it.
Exactly.
And we can really see the impact of these pressures when we look at their margins, can't we? The EBITDA margin.
Yeah, the earnings before interest, taxes, depreciation, and amortization. It's a good indicator of core operational profitability.
Right, and that saw a decline, didn't it? For both standalone and consolidated results compared to the previous year.
It did, yeah. For their standalone performance, the EBITDA margin dropped to 6.8% in Q4 FY25. That's down from 7.6% in Q4 FY24.
Quite a drop.
And for the full year, it fell too, though less sharply, 7.9% in FY25 versus 8.3% in FY24.
Okay, and consolidated.
Similar story. Consolidated EBITDA margin was 6.4% in Q4 FY25 compared to 7.4% the year before. And for the full year, 7.6% versus 8.1%.
So those declining margins really line up with the cost pressures the CEO was talking about: competition, wages, investment.
Exactly. It ties together quite neatly.
Now, despite these, let's call them short-term profitability challenges, Dmart hasn't actually slowed down its fiscal expansion, have they?
No, not at all. They're still pushing ahead. They added a pretty significant number of new stores.
How many?
28 stores just in the fourth quarter, and 50 new stores over the entire fiscal year.
50 new stores in a year. Wow.
Yeah, their growth strategy is still very much centered on that cluster-based approach. Strengthening their presence within the markets they're already in.
Right, and actually thinking about it, that slight dip you mentioned earlier in the like-for-like growth, even while overall revenue surged, maybe that suggests new stores are becoming an even more critical driver of their growth now.
That's a really interesting point. It could suggest that growth from existing, mature stores is moderating slightly, making the contribution from new stores even more important for that overall 16.7% revenue jump. It's a subtle shift, maybe.
And we can really see that long-term growth when we look at their store count over time, can't we?
Oh, absolutely. It's impressive. They've gone from, 55 stores back in FY12?
Right.
To 176 by FY19. Then a big jump to 365 just last year, FY24.
And now, 415 stores as of March 2025.
Yeah. That's consistent, substantial expansion over more than a decade.
Definitely.
And alongside that physical brick-and-mortar strategy, their e-commerce arm, Dmart Ready, that's also evolving.
Ah, yes, Dmart Ready. How's that doing?
Well, they seem to be focusing strategically on its sort of gradual expansion, but specifically within the larger urban centers. They're now operational in 25 cities as of the end of FY25.
25 cities, okay.
And what's particularly interesting, I think, is their strategic shift. they seem to be moving away from relying heavily on pickup points.
Right, where you order online and collect it yourself.
Exactly, and moving towards building a more robust home delivery network instead.
Ah, so adapting to convenience, really. Bringing the shopping right to your doorstep. That makes sense, especially in busy cities.
It does. And the CEO actually reported positive growth in that home delivery segment, especially, he said, in the major metro areas.
Okay, so that shift seems to be working.
It appears so, and the CEO expressed confidence that this sort of refined DMart-ready model focused on home delivery in metros is genuinely scalable and relevant.
And why is that? What's the logic?
Well, the foundation is really DMart's existing reputation for value, for low prices, and the wide range of products they offer. That combination, they believe, resonates strongly with how people shop online in these big urban centers.
Right, the same EDLP, everyday low price proposition, just delivered differently.
Exactly. Value and assortment now with home delivery convenience in key cities.
Okay, so moving beyond just the headline revenue and profit figures, what other key financial metrics maybe caught your eye from the reports?
Well, you mentioned the like-for-like growth or LFL growth earlier.
Yeah.
That measures sales performance in stores open for at least 2 years.
Right, how the established stores are doing.
Exactly, and that came in at 8.4% for FY25. Now, that's still growth, but it is a bit lower than the 9.9% they reported back in FY24.
So a slight slowdown in growth from mature stores.
Seems like it. It's worth remembering, of course, that crazy negative LFL growth of negative 13.1% back in FY21.
Oh yeah, the pandemic year, that was an outlier.
Total outlier. But yeah, 8.4% in FY25 suggests continued growth in established stores, just maybe at a slightly more moderate pace than the year before.
Okay, what else?
We also see that the total bills cuts, which they measure in crores, that's generally shown an upward trend. It reached 2.0 in FY25.
So more transactions happening overall.
Seems that way. And their total retail business area, the actual square footage of their stores, hit 17.2 million square feet at the end of FY25.
Wow, 17.2 million square feet. That clearly shows that expanding physical footprint we talked about.
Absolutely. And adding to that, the revenue they generate per square foot, that stood at INR 33,896 in FY25.
33, nearly 34,000 rupees per square foot.
Yeah. And then looking at operational efficiency type metrics, their days inventory outstanding was about 31.4 days.
So how long stuff sits on shelf or in warehouses?
Right. In days payables, how quickly they pay their suppliers was quite low at 7.2 days.
They pay quickly.
Yeah, seems so. Their fixed asset turnover ratio was 3.4, and their inventory turnover ratio was 13.6. These metrics, they give you insights into how well they're managing their assets and stock levels.
Right, the nuts and bolts of the operation. And finally, what about their financial structure? Debt levels.
Well, that's quite remarkable, actually. Their debt-to-equity ratio remains incredibly low, just 0.03.
0.03, that's tiny.
It really is. They had total debt of only 693 crore compared to a huge equity base of ours. 22,230 crore.
So a very strong balance sheet, minimal reliance on borrowing.
Extremely strong financial foundation, yeah.
Okay, so looking ahead now, any hints about future strategy or leadership changes?
Yeah, there's actually a noteworthy development on the leadership front. A gentleman named Anshul Asawa has been appointed as CEO designate.
CEO designate.
Okay. And he's expected to take over the day-to-day operational responsibilities for the main retail business within the next few months.
Interesting. So what does that mean for the current CEO?
Well, the idea is that this strategic move will allow the current CEO, Mr. Neville Narona, to actually dedicate more of his focus to key strategic areas.
Like what?
Things like accelerating the pace of new store openings, which we know is crucial for them, further developing their e-commerce capabilities with DMart Ready, and also exploring other potential non-retail growth opportunities.
Okay. So it definitely suggests a kind of strategic evolution, maybe, with perhaps an even greater emphasis on expansion in the online side of things.
That's certainly how it reads, freeing up the top leadership to focus on those big growth levers.
And it was also quite insightful to note the CEO's comments on how different regions are performing, wasn't it?
Yes, that was interesting. He mentioned that while the metro areas are showing resilience, they're actually seeing stronger performance.
Where?
And better like-for-like growth in the non-metro towns, especially, he noted, in those areas where DMart has a lower density of stores currently.
So that highlights a pretty nuanced picture, doesn't it? Different market dynamics playing out across the country. Maybe more room for growth in those less saturated non-metro areas.
It could suggest that, yeah. a deeper understanding of where the growth opportunities might lie geographically.
But through all this, their core strategy remains the same, right?
Absolutely essential to remember that. Their fundamental strategy is still firmly rooted in the everyday low-cost, everyday low-price model, EDLC, EDLP.
Right. That core value proposition, it's deep in their DNA.
It really is, and it continues to be the guiding principle behind pretty much all their business decisions.
Okay. And lastly, before we wrap up, there was something about taxes, a potential issue.
Ah, yes. It appears there are some ongoing Goods and Service Tax Act demands that the company is currently dealing with.
How much are we talking?
Both their standalone and consolidated financials mention demands somewhere in the range of ours, 18.76 to 18.79 crores.
Okay, not insignificant.
No. And the company stated its intention to file appeals against these demands. They're classifying them as contingent liabilities for now.
Contingent liabilities meaning it's a potential future cost, but not certain yet.
Exactly. Something to just keep an eye on in their future financial reports.
Right. Okay.
So let's try and recap our deep dive into DMart's latest results then. We've seen a year really characterized by, well, strong revenue growth across the board. That 16.7% figure stands out.
Yeah, very consistent top-line growth.
But that last quarter, Q4, it definitely brought some headwinds on the profitability front.
Right, that profit growth lagging significantly behind revenue.
Yeah, driven by that combination of increased competition, rising labor costs, and those ongoing strategic investments in service and future growth.
And at the same time, they're absolutely continuing their aggressive physical store expansion,
50 new stores this year.
while also strategically refining their DMart-ready online presence, particularly focusing more on home delivery in those key metro markets.
That's a pretty good summary of the key dynamic.
Absolutely. And I think this has been far more than just, a surface-level glance at the numbers. This deep dive hopefully gives you a much better sense of the underlying forces really at play within Avenue Supermarts right now.
Hopefully.
So here's maybe a final thought for you to consider as we finish up. Given these pressures we've discussed on their profit margins,
Yeah, the competition, the costs.
running alongside their really ambitious plans for growth, both physically with stores and online with DMart Ready. What do you think will be the single most significant strategic challenge for Avenue Supermarts in the year ahead?
It's a great question to ponder.
How will they successfully balance maintaining that strong value proposition for customers that EDLP promise, while also ensuring they achieve sustainable and, importantly, healthy profit growth in what's clearly a very dynamic and evolving retail environment?
Finding that sweet spot between growth, value, and profitability.
Exactly. It's definitely something to think about as you continue to follow their story.